Good evening and welcome to tonight's event where we focus on our CVVC Top 50 report. We're looking back and we're looking ahead. What's next? For those of you who don't know what CVVC is, CVVC stands for Crypto Valley Venture Capital. We are a VC with a plus and we have two specialities. Number one, we invest in startups that build products or services based on blockchain technology. It's the so-called picks and shovels approach. Number two, we have our own operational ecosystem business called CV Labs, which consists of co-working spaces, advisory. We organize conferences and run our own incubation and acceleration programs. This brings me to our investment approach, which is based on two pillars. Number one, for the really early projects in the pre-seed stage, we run our own incubator with a standardized offer of up to 20 startups per batch and investments up to 125,000 USD in return for 10% equity or tokens. For startups that are seed to pre-series A, we have a direct investment approach where we currently invest up to $500,000 USD. So far, we've made 37 investments, 27 came from our incubator and 10 were direct investments. For qualified investors who want to invest with us, we offer a range of investment products from pure play venture capital, where you get exposure to our portfolio of startups that build on blockchain technology, to a fund of fund approach covering the best digital asset investment strategies. Tonight, we have two panel discussions for you. In the first one, we are looking back 2021 in review, DeFi for retail. What's next in 2022? We have Floftech's Anton Golub, we have Signum Bank's Rico Müller, we have Swissborg's Cyrus Faisal. Everything is moderated by Pascal Hügli, founder of Insight DeFi. And the second panel discussion, 2021 in review, DeFi, a game changer for institutions. What's next in 2022 with Bitcoin Swiss's Mauro Casellini. We have Alliance Blog's Rashid Ajaya, we have MMA Legal's Andreas Glaner and Aves Rebecca Retting. Everything is hosted by Michael Svoboda. He is COO at Liquidity.
Welcome to the Crypto Valley Top 50 report. The key facts are as follows. The valuation of the top 50 companies in Crypto Valley, which includes Switzerland and Liechtenstein, increased to $611.8 billion. That's over 400% more than only 12 months ago. The number of companies now stands at 1,128. And there are over 6,000 people employed in companies that relate to crypto and blockchain in Switzerland and Liechtenstein. 14 unicorns make their home in Crypto Valley. That's up from 8 in 2020. We saw the first large acquisition in financial services by an innovative player from outside of Switzerland. Also on the protocol side, we saw the first acquisition of a layer 2 protocol by a layer 1 protocol. Protocols and projects continue to set up in Switzerland and raise money thanks to the regulatory clarity that exists in Crypto Valley. In DeFi, some of the largest protocols count the Crypto Valley as their home and they continue to grow. And in the traditional finance space, the secondary markets built on DLT infrastructure are now live. Bonds are traded on licensed DLT trading facilities. Thanks to the best regulation in the world, a thriving ecosystem, and dedicated entrepreneurs, we can expect that the Crypto Valley will remain the global leader in blockchain and crypto for many years to come.
Welcome to today's event about the future of DeFi. My name is Adrian Keller. I'm a partner at PwC's financial servicing practice, focusing on crypto and asset management. As a starting point, I want to give a short overview what DeFi is all about. DeFi is basically rules that are embedded in programming code. The principles can be used for commercial use cases in principle, but especially for financial services, where conditions are embedded in a smart contract that automatically executes transactions based on the occurrence of conditions. This allows us to execute financial products and financial services without the reliance on a regulator or intermediate to secure the execution of that product. There are some advantages that come along with DeFi. The first of all, it doesn't require an intermediary and therefore there is less cost involved. The second one is that everybody has direct access to the digital assets without reliance on a third-party custodian. And third of all, everybody that has internet access is basically part of the industry without requiring a further approval. However, there are challenges that go along with it. First of all, it's the reliance on high-quality code. And the second of all is that there's still a lack of rules that actually prevent from abuse of the DeFi opportunities. And third of all, the infrastructure that is required is not standardized to a level that institutional clients would use the infrastructure. You can read more about that in the PwC report about DeFi on our website. If we look at the development of the DeFi market, we see that in 21, 18 billion US dollars have been locked at the total value, whereas in January 22, the total value locked in DeFi has increased above 200 billion. This clearly shows that DeFi services and products can be provided at scale. Now the question is DeFi and smart contract basically replacing the traditional financial industry as we know? We do have several companies that work on solving that problem. I'm now handing over to Pascal Hügli, the founder of Inside DeFi, for the first panel discussion. Pascal, the floor is yours.
Hello, everyone. Yes, I'm pleased to be here tonight at this CVVC Top 50 event. A very big thank you to CVVC for inviting me and all the panelists. My name is Pascal Hügli, and I'm founder of Inside DeFi. I will be your moderator for the first panel session tonight on the topic of DeFi, a game changer for retail and institution. So for the first panel, we will actually cover the retail side of things. And yes, I think I have an exquisite list of panelists that are with me to tackle this very question. What's next for DeFi in 2022 for retailers, or when it comes to retail? And with me tonight is Anton Golub, founder and CEO of FluffTech, and Cyrus Fazel, founder and CEO of Swissborg, and Rico Müller, product manager and vice president of Signum. So yes, being conscious of time, I would like to start right away. And I would like to start with a quick reference to a report that I read last year. And since we're covering the retail side of things, I read this report by Chain Analysis, on DeFi, particularly on Ethereum. And one of their main finding was that Ether or DeFi on Ethereum is pretty much dominated by institutions. So my first question, actually, and I think we need to get this out of the way, is will DeFi be for masses in the end, or will it turn out to be a whale play only? Maybe Rico, if you could tackle this question from your perspective first.
Yeah, sure. Thanks. I think DeFi definitely adds a lot of value to the masses, and not just for whales. I think it just depends on what you're looking at, right? I mean, if you look at Ethereum L1, then absolutely yes. You do not want to be making a ton of transactions there as a small player, and there you would see definitely in terms of volume much more like whale transactions, because the gas costs are just too high for people with small amounts of capitals, and the fees will absolutely like kill any yield that you could earn there if you do this with a small amount of capital. And I mean, this is not going to change, at least for like Ethereum L1. Gas costs are up only, and the merge and like even sharding won't change that, right? But That's what we have L2s for, the optimistic rollups like Arbitrum or Optimism, or the upcoming ZK rollups, or like even alternative L1s like Polygon, Avalanche, the Terras of the world, etc. And transaction costs there are much cheaper, like to the point where it's attractive to transact also for people with small amounts of capital, like even $100 or even less. And their DeFi absolutely does add a lot of value for people, and also for retail. I mean, it's 24/7. Like you can get a loan without having to fill out a credit application. And then, of course, like all the opportunities to earn yield, which will definitely be higher than like close to the 0, or for sure less than 1% that you will get in your bank account currently. So yeah, and then I think also, like, let's not forget that whales and institutions are not just like extracting value from retail users, but also adding value to the ecosystem as a whole. I mean, like that's where a lot of the liquidity and market making comes from. And that's not retail users, right? But they still profit from those players being in the ecosystem. So yeah, I do think that it's not just a whale game in that sense. Yeah.
Okay. Yeah, nice. Anton or Cyrus, do you have a similar view on this?
So I can just chip in and just maybe from our perspective to clarify, when we mention institutions being part of the DeFi, I think we need to point out that this is not traditional asset managers and banks and pension funds deploying capital. That just doesn't happen in DeFi space. When we talk about institutions, we're talking about proprietary trading firms. We're talking about market makers, hedge funds that have a very loose governance structure in a way how they can deploy capital, how they have to deal with custody and things like that. And also big players like lenders, so on a treasury basis, they deploy a lot of capital in the DeFi space. So this is kind of how I would say it, when people refer to institutions. Now, talking about retail, just to mention that from our perspective, DeFi at the beginning really was a retail play. If you remember in 2020, when a lot of these DeFi protocols were kind of coming up, actually it was only the retail traders, if you can call it like that, or the whales who were very crypto native, big traders that were very crypto native, they were the ones who were deploying capital there. And kind of what happened over time now, as the protocols were evolving, and what actually Rico flagged, that they actually Ethereum is unusable. Meaning if you're a retail player, due to the gas fees, it makes no sense to deploy any funds or capital there. So I think later we'll touch upon that. Today, what's very interesting from a retail perspective is actually other chains. So for instance, at FluffTech, we're a big fan of Terra, and I'm a big fan of Terra. And there on Terra, you have very low transaction fees when you want to do anything DeFi related. Yeah. So I think, looking at the new opportunities that that retail will have in 2022 and moving back, all the retail action is actually happening on other chains. It's just not happening on Ethereum, and maybe it will happen one day on Ethereum when we go through certain upgrades, or on layer 2 solutions also with Rico Flagged.
Nice.
Yeah, thank Anton for this and Rico as well. If I could add something, Pascal, is that it's not going to masses yet, because look, if you're someone who's not into crypto, and sorry, Anton or Rico, what you just said is just fucking Chinese, man. It's super complicated, right? Because, how do you get from a regular person to understand what's layer 1, what's layer 2? How do you configure your MetaMask? How do you start looking at the really wild west of DeFi, which goes from the more secure compound Aave to the ones I will not say that are completely hazardous? And the fact that this intensity of looking for liquidity pools on a 24-hour basis just doesn't make sense. Because if you really want to extract the value from the pools, well, unfortunately, what you have to do very often is that you just have to monitor every liquidity pool, and on you have to essentially look for it. There's like cool ways such as Yearn or different other platforms that are trying to decentralize and bring you how to get to this. But there's, I would say, a very, very big amount of obstacles for the regular person to first get interested in DeFi, because it's something that is quite hard to understand what is the value for some people, right? you know, when you buy a Bored Ape, for example, you see the value directly. It's great. You have this great monkey, right? To increase, you know, your holdings for some people is not that interesting. Second is the technological issue, as you explained. The third is then to find the right platforms, which gives you the confidence to build up there. And then the last is to retain people by what you always have to actively look for the next liquidity pools. And I think so for now, like in DeFi, it's a very small amount of people. We don't realize that how small in terms of volume, it's huge, right? We're like across the different assets, we're probably at, you know, 50 to 150 billion assets pledged in these smart contracts. But in terms of people, it's very, very small actually. And that has a multiple different layers. I think so. One thing that Swissborg has brought is that, you know, you could start yielding within 2 buttons. And not only us, but there's other platforms that are doing the same thing. Is how do you get to reduce that pain of people in order to get into DeFi? And I think so there's a lot to improve there. There's a lot of talk about risk, and I'm sure we'll talk about that a little later. But yeah, it is very complicated yet, and it is very risky to bring Mr. Everyone in DeFi for now.
Yeah, great perspective, Cyrus. I actually appreciate this. And I would ask the other ones, I mean, you already alluded to it, you know, how can we get this obstacle out of the way? Because, you know, having these many layers and then also the fragmentation of liquidity and stuff, you know, I think that's not going to help. So what are the ways that we can really work on this to get these obstacles out of the way? Do you have anything to add, Rico or Anton?
Yeah, sure. I think that Cyrus already alluded to it, right? If you have these, also if you have multiple like chains or like even layer 2s, that you have these issues of fragmented liquidity, and I think also for ease of access, what we need is actually service providers that provide like like sort of an aggregator service which can tap into DeFi like on different chains or even like provide a single point of entry basically. So for the user, it's very easy, and they don't even know that their transaction was executed like on an AMM or lending pool on Ethereum or Terra or Solana. You just do your transaction, you know what you're getting your yield, or you're getting your asset that you're swapping. And you don't even know what's happening in underneath, right? And that's where Cyrus is very correct. Like right now, there's not many products that offer that, but I think that's where we will go in the near future for sure. Yeah.
What I can add to this is that at least that's what I see or hear very often, actually, from perspective of people who are very interested in crypto, but still retail traders or retail investors, is that very much what happens is that they have a thesis around a particular chain, or they have a thesis around particular applications, and kind of that's how they dive deep into that rabbit hole. So what's been alluded, I mean, today you have so many relevant actually blockchains, so not irrelevant, but relevant blockchains, that it's hard to keep track of even what's happening on each one of them. So that's kind of what I hinted at the beginning, saying I personally love Terra, and people around me personally love Terra, but now for me to know what's happening, even though I like Near as well, it's very actually difficult to do that. This is something that, you know, it's touched upon in terms of the aggregation platforms. What I can say is that if you're not, as a market maker, what we can say is if you're not a professional trader, you don't really have easily access to this kind of platforms for many different reasons, yeah. But I definitely see, if I have to reflect backward, you know, kind of how things evolved, definitely having many chains and many blockchains and many protocols that become relevant actually increases liquidity. So it's not the case that you actually fragmented things over time. That's applications or platforms fragment access to liquidity over time, but actually a growing ecosystem increases liquidity, and it does that very strongly. So I'm actually very bullish on that side. But, you know, I think also sometimes, as maybe Cyrus has the most contact with the people who are the end users and kind of making those first steps into the crypto space, sometimes we have to, you know, take a step back and realize, you know, you do have to be a bit of an expert, you know, and know what you're doing when you're playing around with a lot of these DeFi protocols, you know, a little bit of an expert, yeah.
Yeah. Yeah, exactly. Want to add something, Cyrus, or?
No, please go for
Okay.
it.
No, I mean that's a good point. I mean, you alluded it to now, or that's at least what I heard, Anton, when you said about the experts. We usually talk about the DeFi degens, in DeFi, and it's pretty much probably been their field of play, so far. I mean, one thing to get the common person, into DeFi would also be, or that's what I'm hearing, to get DeFi to make it more sustainable, because that's what the people then they sometimes don't understand it. And if they understand it or see that there's these high yields, they're like, that cannot be sustainable. And so my question would also be, how can we get these DeFi protocols to be more sustainable, and how will it be? Yeah, how can we get there? Cyrus, do you have anything to add on this?
Yeah, I mean, it is a hard thing because the beauty and the same time the issue about crypto is today we're seeing in DeFi applications that you could copy paste anything, and you could, your sushi swap to Uniswap to blah blah swap. This could happen very rapidly, and then that sushi swap, then you do it on a new chain, and that's a blah 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 swap, and then you go on Terra, and then you go on all these. So you could start bringing liquidity, but as well building applications very rapidly. And in order to bring assets to, do the vampire attacks or whatsoever, as we call it, DeFi, well, you just do stupid yield, right? You like, come the first day, my liquidity pool, my platform, I'll give you 1,000%. And, that's going to last for a few hours, but you still go there because you're like, why not? And that is a little bit where I don't see the sustainability, because it's just about flipping and flipping. And then whenever there's a V3 of a new platform, just Uniswap send their V3, I was like, oh, we don't have it. Okay, copy paste. So this is where it gets a little tricky. And I don't see, on a lot of different platforms, I don't see an application. I don't see yet the real value that is bringing one from the other, right? And that is, to be honest, it'll be hard to see how this is gonna change, because it looks like it's just a too easy thing to do. Where that, but the beauty at the same time is that, if you want to start working with a bank and doing lending assets, it would take you already a month to onboard with this corporate bank, right? And do the whole KYC and do all this process. Where you hear in DeFi is projects just come out of nowhere, and after 2 months they have 5 billion pledge on their platform if they're very successful, and if they do building new value into it. So I think that's the beauty of it, is where things go rapidly, push up like mushrooms, and then copy everywhere and proliferate. And at the same time, well, the thing is that you have that flip side. I mean, you have the good side, which is anyone could yield farm on your platform, lend, borrow, get leverage, and now we're seeing even new cool stuff where you're getting NFTs out of DYDX is a good example. So I'm hoping I get that hedgy of the DYDX, where you get that little cool perk, and that could create on-chain meritocratic score. So we're seeing more and more things where we are connecting more value to our super users through crypto. And I think so those are the one probably that will give the more sustainable way, is where we start saying, okay, if you just come for one day and you yield farm and you just move and you go to each platform, maybe I won't reward you in the same way. Whereas if you really yield farming this platform, you stick with their tokens, then you start pledging staking the tokens of the platform to pass initiatives and vote, and really develop the sustainability, then we'll probably see a lot of projects that are growing. And Aave, for example, it's a very good good platform. It has over 20 billion pledged there. There's already I think so we're more than 15,000 people that are staking their tokens, that are voting on initiatives, and I think so that's where we see the more sustainable projects.
Yeah, interesting. Yeah, maybe to build on one of this thought, of the paradox of openness. I like this, because it is really a paradox, that everything is open and you can vampire attack everything. The question I would have maybe for you, Rico, is then, will it be the protocols that somehow need to build some modes, that they can kind of grab this liquidity and also keep it, and that we don't see this continuous yield farming and people just farm everything to death, So will it be up to the protocols, or will it be up to the retailers to actually grow up and really, don't do this anymore? So how do you approach this,
I think that's a really good question, and Cyrus put it actually brilliantly, right? In the traditional world, you have contracts and you have like legally binding agreements where you can steer that. In DeFi, it's all permissionless, and so you have to sort of do it from a different angle. And I think yes, it comes down to the teams, to the projects, to actually come up with like a good design. So you have to do it with like incentivation and like actually good game theory, right? So like that all like players are aligned, because you can't really enforce it, right? There's no, as I said, it's permissionless, right? So if you have like a liquidity mining program, like with all like inflationary like emissions, and you will attract a lot of like mercenary capital, and this will disappear very quickly, like as soon as the liquidity mining program is over. So, and obviously this isn't good for the project because they're spending like they have costs with the emissions that don't really provide much value as soon as the liquidity is gone. It isn't good for the users because the liquidity is gone, and it isn't good for token holders either because they get dumped on by the farmers. So I think it's up to the project teams to come up with a good design, like sensible tokenomics that actually like align incentives and like incentivize participation and good behavior. This can be done, for example, by rewarding users with cash flows, or like have a tokenomics model that incentivizes users to hold tokens instead of dumping, like through sort of like a lock mechanism in order to get the fees. And this also builds then like a loyal community, right, which has a stake in the success of the protocol. And this is very important for, in general, in DeFi to be successful, to have a good community. And I think you can achieve that through a good alignment of incentives. And so in that sense, like again, to go back to the mercenary capital, don't hate the player, hate the game, right? They just build proper incentives, and it isn't easy, right? But I think that's the angle you have to play, definitely.
Yeah, interesting. Well, when we talk about DeFi, sustainability and also, then we have to mention yields, and maybe Anton, to your questions, this is also something I hear quite a lot, where these huge yields come from in the beginning, and also, what are the risks? I think when something has really high yields, you always have to reconsider and also look at the risk. So could you maybe shed some light there?
Yeah, sure. So first, I would like to mention that when we talk about high yields, you really have to separate between what you would call liquid tokens and then highly liquid ones. So if you have a yield of 8% on a dollar stablecoin, that yield comes actually from the market demand. So for instance, why is it that, why is it that when you lend out your stablecoins at 8%, you get that much, is because market makers, proprietary trading firms, and hedge funds, or FluffTech actually borrows at those amounts. Now you can argue that we are paying too high, or that the real interest rate is actually not zero. And I think depending on who do you ask, you will get different answers. I think maybe the crypto community will say, well, maybe zero is not the right interest rate, but it's 8% or somewhere in between. But this is the reason why there's a non-zero interest rate in a particular part of the world, meaning the crypto industry. There are specific examples when that yields are higher even than that. For instance, again, talking about Terra, there's a protocol called Anchor, which is borrowing a lending protocol where you can get 20% yield on your stablecoin. Now, the question is, how can that reality exist? It's a very simple answer. There's a subsidy. There is actually a treasury position that's being built out that pays that subsidy. So that means actually then you can actually borrow at 8, for instance, as a proprietary trading firm, and then you can lend out at 20 at Anchor. And there are very good reasons why that happens, but the underlying mechanism is there's a subsidy. Now, talking about illiquid coins, there the subsidy or the incentives really comes from the projects, meaning it's an inflationary mechanism that motivates people to provide their capital, their tokens, and in return, they get an extremely high yield. But obviously, to anybody who thinks about that, if the yield is 1,000% per year, that's a non-sustainable yield, both from a perspective that nobody has infinite amount of tokens to give out as a reward, and also it's unsustainable from a perspective that inflation actually causes price drops, actually, meaning your token, your money is less worth over time if there's an extremely high inflation. So I think this is one of the risks that also as well that you flag, is that just the treasury runs out and you cannot support this kind of high yields, both when we're talking about liquid coins or when we're talking about highly illiquid ones. Yeah. But in terms of what's the solution there, the solution is actually to bring back the yield in reality. That means maybe the 8% is reality, both in the crypto industry and the traditional finance. 20% is not real. And likewise, having 1,000% yield for a illiquid coin as an incentive to provide capital there just doesn't fly in the long term, and it's always corrected. This is our experience.
Yeah, that's a very good breakdown, Anton. And it's funny because, you know, definitely we're big Anchor and other projects. We're big fan. But some people can still sustain it if you just print infinitely tokens, right? Pancake swap is pretty much the case. And look, it's working. It's a great platform. You know, I personally, I'm on Pancake. You know, Cake has been doing quite well, and their models, like, they're like, okay, you know what? Just gonna print as much as the Fed does, and let's see how we go from there.
Yeah, nice. Yeah, it's true. It's nice. You guys have already been mentioning now some protocols, you know, Anchor, PancakeSwap, new now Cyrus. So maybe to get some more hints on how to hack DeFi, you know, can you point out some good DeFi protocols that you think will also be here in the long term, you know, and maybe if so, what are they doing right, you know? Can you? Yeah, it would be nice to know some things here.
Yeah, I think so, if I may. So how do you look into the rating of these DeFi platforms? And it's pretty much impossible. That's where the biggest risk is, right? Is, you know, there's a lot of different ways. So how does Swissborg approach it? So we just developed a team because we just figured out that no one really did it so far. And everyone has his own methodology. But what you could usually go is like, first thing, who's the team? Very often you'll not find the team. Okay, so that if you find the team, if they put in, you really do the due diligence, I think so it's a good way to say, like, okay, you know, at least they're accountable somewhere. Second is to see, like, obviously, who are the backers, and if there's like big backers, like through our capital or Coinbase Ventures or you know, Anderson and all these big, you know, and super investors. Most probably this is a good thing. It doesn't mean still that it is you know, good to go, but at least it does give some background. Then I would say there's other different things that you should be looking forward to, and there's are more I would say technical. So obviously looking on what blockchain it is, then understanding you know, the mechanism behind the oracles, the wallets, the vaults. And those get to be really hard. If you cannot do that by yourself, you could still look if there's other people that have audited. If you see a lot of auditors, there's some good auditors, there's some so auditors. So that again is another way that people can unfortunately not rely 100% on. And a lot of people look at TVL, which is somewhere true, but it doesn't mean if there's a lot of TVL that this thing is going to go forever. Just put this very clear, because as we said earlier, TVL could go very rapidly, could fly out very rapidly. And we all have probably witnessed on a personal or on a corporate level, at one time we got squeezed on one deal, and it has happened. And that's what you people should face. There is impermanent losses in crypto and DeFi. And yeah, but the good thing, what I just maybe last I finish with that, is that I like trying a lot of things first on a personal level, because usually when you try out things, you get airdrops. so if you try a lot of different things, and these guys don't have a token, like whatever it is, like, you know, just do it, and most probably your wallet will be rewarded. And I know that in many times I haven't been I just tested out things, and then I was like 3 months later, like, oh, that's great, thanks. giving me $3,000 for just trying once your platform.
Yes, exactly. We all know this feeling. It's great. Yeah. Do you guys have anything to add, Rico or Anton, on this side?
Yeah, I think Cyrus covered it very, very well in terms of like the aspects that you need to look out for to find a good or identify a good project. I would just, in that sense, like from my side, just point out like one project that I think is doing a really good job at like producing sustainable yields and being a good product, which is Curve, and like the whole ecosystem that has developed around it with Convex. And yeah, unfortunately, we don't really have enough time. Like this is a huge topic. Like it's a lot to unpack, but basically, like you get really sustainable yields from Curve because you get fees, and you also get voting power to basically direct the emissions to different pools. And because Curve is such a good product, like it has huge liquidity, I think over 20 billion in TVL, which is definitely the largest in DeFi, and like because of that liquidity and because of the special Curve that they have, like low slippage trades and large volumes, every project wants to have a pool in Curve, especially now that they launched the Curve V2 pools, which is non-pegged assets. So for example, CRV ETH. And in order to get the liquidity then in these pools, these projects want to incentivize the pools with CRV emissions, for which, then this whole recently this over the past year developed like a sort of dynamic in the market where projects want to accumulate CRV to lock it, and also even directly like pay CRV holders to vote for their pools. So I think again that we don't have enough time to dive into everything, but to sum it up, basically you can get on one token up to like 50% average APR, a very sustainable and stable yield. So I definitely would recommend you to look into that.
Yes, sure. Anton, do you have anything to add?
Yeah, I was just reflecting on something that earlier said by Cyrus. So I will actually mention two protocols, but then I say why I'm mentioning it. So it's Vega protocol, which is a decentralized derivatives platform, and I'm actually there participating in ensuring actually the safety of the protocol by staking my token. The reason why I remember it actually because I didn't know how to do it, so I called the founders to walk me through the process actually, and talking Cyrus like how easy it is. I had to call the founders to explain that to me. And the second protocol where I know the founder, but I'm a very big fan of it, one of the oldest protocol in the crypto space, called Enzyme, former Melonport, which was founded by Mona Elisa, which is an asset management optimization protocol, which I'm a huge fan and will have big applications hopefully one day. So I'll kind of leave it at that, two very interesting ones. And in both, I had to know the founders to even know what is going on there, which says a lot about the ease of use.
Yeah, great. Thank you, guys. Well, I mean, now that we already mentioned some protocols, I want to come back to you, Cyrus, real quick before we finish up. You mentioned the airdrop. So is there any airdrop that you have or potential airdrop, a project that you just recently tested, that you could allude us to?
There hasn't, UI UX, obviously that was one, but I was really using it. There was a few of them, but recently, no. I'm maybe less curious. Anthony, I should ask him. But I know that we're working obviously on different things, and most probably this will happen as well. We will do probably airdrops as soon as we'll talk about what we're doing on the DeFi space. But I think so. That's people should be curious. I think so. There's even a Twitter handle that actually there's like two guys that that's the only thing they do. They're like, please try these guys out. There's a high chance of doing it. I forgot what's the name of the guy.
Yeah, exactly. There's Twitter. I don't remember the name, but obviously, also with all the second layer solutions now emerging on Ethereum, I think most of them don't have a token yet. So this is obviously
that's
an
the big
obvious
one,
choice and an interesting one. Well, guys, we're pretty much done. Thank you very much for your very great insights. It was nice to know. And I think you all are probably on Twitter or available anywhere else. So people can just reach out to you if they have any further questions. So,
Pascal, can I just add one thing, if you don't mind, if that's okay? So I'll just tell you one story recently, which is really cool. We saw some stats on Swissboard, and every month we have roughly 70 users that come on the platform. Half of them, 70 of them do a transaction, half of them go into DeFi. I'm just going to ask you a question to all of you on the panel. How old do you think this cohort is of 35 people that get into DeFi per month at Swissborg?
Interesting.
Early 20s on my side.
I would also say early 30s.
They're over 80 years old, guys.
What kind of client base are you targeting, Cyrus? I'm curious.
We have 50,000 people that come per month, but out of those, we have a very small amount. And I think so, not to talk about Swissborg, but I think so you need to have killer apps that will enable people just to click on 2 buttons to get into DeFi. And I think so that's how mass adoption will happen. And obviously, if you game it and you give governance, as you explained, Rico earlier with like Curve and these fantastic projects, but you would eventually need people just to click 2-3 buttons to get into it.
Great finishing line, Cyrus. I think that's really it. DeFi is for everyone in the end, and then we have to make to bring it there. Yeah, that's great. Well, thank you guys. Thank you very much. I hope all the listeners enjoyed it. And so the questions that you guys answered, we hopefully can take them on YouTube and then answer them. And thank you guys. So have a great evening, and talk to you guys later. Thank you.
Ciao, bye-bye.
Open source blockchain-based software. To date, we are best known for the development of the Aave protocol, which is an open source, non-custodial, decentralized liquidity protocol, which allows users to borrow and supply crypto assets and earn interest on their assets. And in addition, we just deployed in a soft launch our new decentralized social media protocol, which will allow content creators to essentially build their own personal economy off of their content in the form of NFTs and the like.
I'm Mauro Casalini. I'm the CEO of Bitcoin Swiss Liechtenstein. It's one of the Bitcoin Swiss companies. We are nowadays more than 300 employees based in Switzerland, Liechtenstein, and Denmark. And our main offering is, I would go in the direction of crypto financial services in general. So we are a prime broker, offer custody solutions, offer staking, and in the end, offer the access from the centralized world to the decentralized world to all kinds of clients. We were founded in 2013, so are quite an old company in blockchain terms, and it's a pleasure for me to be part of that panel.
Let's go to Rashid.
Hello guys, so my name is Rashid Ajaja. I'm one of the co-founder and CEO of Alliance Block. So in a nutshell, Alliance Block, we are building high quality end-to-end infrastructure, that will empower companies, institutions, and innovators of all sizes to leverage the power of decentralized technology, and more specifically DeFi. So the main industry that we are focusing on is, of course, traditional finance, because our objective is to build the compliant bridge between both worlds. So through our compliance, data, and DeFi solution, as well as our ecosystem of partners from both decentralized and traditional space, financial institutions will be able to access seamlessly and compliantly the vast and growing opportunity sets offered by this new industry.
Thanks, Rashid. Andreas?
Hi, everybody. My name is Andreas Glarner. I'm heading the FinTech DLT blockchain team at MME. MME is a corporate law, legal, tax compliance advisory firm based in Switzerland. We've been very active in the DLT blockchain space since now 2013, basically advising all of the ecosystem players that have been...
Including us.
Including you, yeah. Thank you, Rebecca, for stating that. So a lot of layer ones, many applications, a lot of DeFi projects, but also financial institutions integrating digital assets and now starting to integrate DeFi topics into their world.
Cool, thanks a lot. So my name is Michael Swoboda. I'm CEO of Liquidity. That's a borrowing protocol, DeFi protocol that offers interest-free loans. And what I love about the panel, just to summarize it, so we have these different players. We have Aave offering DeFi products. We have Bitcoin Swiss tapping into DeFi from CFI. We have Rashid kind of providing solutions to connect them, and kind of Andreas, the legal regulatory view. So we have all these angles. So that I think is really cool. And as a first step, I would like to give the audience an idea of what we mean if we talk about DeFi for institutions. So I would really like if you could highlight some use cases you're working on, because these use cases aren't that in the public, to give our audience an idea.
Sure, I can start if that's helpful. So we had, as a company, a number of institutions come to us maybe a year, 18 months ago, and they were more crypto native institutions to say, we really want to use DeFi. We do have a number of regulatory things that we have to comply with, including KYC, AML, and SATF guidance and things like that, depending on where they were located. What can we do to use DeFi? So in order to try to work with it within those bounds, we created something from the technological side called Aave Arc, which is a version of the Aave protocol. So the same Aave v2 smart contracts are being used, but there's another layer of smart contracts on top that allows for who we are calling whitelisters or permit listers to conduct KYC and AML on institutions and obviously verify their wallet address and things like that, and then permit them to come into this separate deployment of Aave. And so only people who've been KYC'd and approved by whitelisters can go in and interact, provide liquidity, but otherwise it functions exactly the same way. There are two interesting pieces to this. One, obviously, that Fireblocks is the first whitelister. They made a proposal through governance. So just like the traditional permissionless Aave protocol is controlled by governance, Aave Arc is also controlled by governance. But institutions are making proposals to Aave governance to be whitelisters. And then as shown in Fireblocks' sort of first press release on this, they had at least 30 institutions already whitelisted to be brought in. And then the last piece, especially given the Swiss tilt of this panel, is that Seba Bank also made a governance proposal to be a whitelister as well, which I thought was really interesting, from being a regulated bank to be a whitelister in this permissioned Aave protocol. So I think that's this. I would say it's step one to have this type of sandbox of DeFi for institutions. It's really the first of its kind, but I think it's a good first step.
A quick follow-up question, Rebecca. Just going one step back. I mean, why are these institutions interested to tap into that? I mean, before talking about the solution, just kind of what is the motivation and the opportunity they see? And you said these 30 companies kind of, or said in a different way, what are the others missing out?
Yeah, so I think well, I don't think they're going to be missing out for long. I can say in terms of the inbounds we see with inquiries, not just about AveArc, but generally for DeFi education, traditional financial institutions, like regular, banks that you're used to seeing are very interested in DeFi. I think the yields are what first got more traditional financial institutions interested in DeFi, right? They're just significantly higher than what you can get if you put your money in a bank or any other traditional financial vehicle. I think the other thing is that there are really new financial primitives, many of which are suitable for more sophisticated investors or players in the financial system. So I think some of that is what attracted them. But I think now it's the yield. The yields got them interested, but everyone is interested in terms of the promise of DeFi. And I think institutions see that it's here, it's not going away, and there's a lot to be done with it because we're in such a, we're still in such a development phase.
Cool. Thanks. So maybe Mauro, you can allude on that because kind of, as I said, you're then more on the product side also. What makes you interested in DeFi and what kind of opportunities you see for your clients?
It goes directly in the direction of what Rebecca mentioned, and that's exactly what I really like with AveArc. And that was also what I would have liked to point in. It's always like people tell me, if I tell them, look, we are building this and that, they tell me, yeah, but why are you doing that? Crypto and blockchain will kill all intermediaries. And I tell them, no. There will be some intermediaries, and some intermediaries will be even stronger and bigger than they are nowadays if they get it, but there will be less intermediaries because we do not need all of the correspondent banks and central custodians and everything anymore, because in the blockchain space, we can take over many roles as one intermediary, and that's what I really, really like. And with AveArc, you have something in between that, as mentioned, is a first step. But for me, if I look at traditional players, even there are some challenges because they sometimes even have in their internal rules that they do not like to work together with German banks or banks from France or whatsoever, even if they could do so. So I'm really looking forward how that will develop in the future, because in the end, even if everyone is whitelisted, some banks still say, yeah, it's fine, they passed the test, but for me, it's not enough. And I really like to see what's going on there. But for us, definitely something like that is amazing. And we move in the direction of regulation. We move in the direction of meeting regulation and DeFi. And for us, it's amazing to see what's happening out there in the space with having solutions that comply with regulation, that help us to get access to that space and do not block it anymore for us.
But can you highlight some kind of the use cases where you see the biggest demand, where you're most excited about to offer?
That's only something I can speak about as Mauro, and definitely not as Bitcoin Swiss. It's for me definitely also the whole yield topic, the whole topic of you can go out there and get a loan 2 o'clock in the morning. You do not need to speak with a central custodian, with a bank. All people are equal. If they bring in the asset, they get the same offer. And that's what I really like in this DeFi space. But that's definitely Mauro Casalini's own personal idea and not something that we as Bitcoin Swiss are working on or are offering already.
Okay, then maybe I go to Andreas. You have a bit kind of view in different projects because you work kind of on the forefront of those. Of course, you can't name that, but can you outline the use cases that people are working on that you think they're exciting, kind of they're also disrupting or game changing, like we call the panel?
Yeah, I certainly can give it a try. I think being in a law firm, we kind of get a set kind of an overview, at least, of the clients who are willing to seek advice, which is not necessarily all of them in the space. But what we see currently is the hot topic at the time being is building bridges. We see that in more in the fund space, kind of bridge between NFT, metaverse, gaming, etc. But here in the CFI DeFi space, there's definitely a lot of kind of creative movement and energy going into creating a bridge between those two worlds and building business products which can be used for a community outside the current crypto DeFi community. And we see that starting very on a low scale, kind of asset management and asset management associations joining up and trying to find out, well, how could we offer DeFi products to our clients as asset managers, and being, how do we do that in a regulated way? Do we need to have any concerns on a regulatory level, and then move on to how can we structure asset management products in kind of a type version 3.0 using, for example, Enzyme Vault, which Anton mentioned earlier, and kind of eliminating a custody role in the setup. So the asset management side is one, but then if you move on to more complex models like exchanges, it starts on a payment utility token type exchanges like whitelisting pools, and then up to the questions whether or not you could operate an automated market making infrastructure being a regulated security trading venue. So those are very interesting questions we are fortunate to be able to work on.
Cool, thank you very much. Before Rashid, I get to you kind of to complete that, because Rebecca, I think you have a hard point. You need to leave soon, I think, in another meeting. So I just wanted to give you the opportunity to touch on a topic kind of which will then come next, is kind of where do you see the challenges? What are the biggest challenges kind of players are struggling with to access these opportunities, which we have seen, kind of the yield, the openness of the infrastructure, the less intermediaries?
Yeah, I think the challenges really come from having a patchwork of different regulations all over the world. I think, there is some sort of standardization for KYC, but it's not definitive. And I think that we're still in a, in a growth period is difficult. But the challenge is educating so that people understand what DeFi is, what it does. To Mauro's point, how this is going to not eliminate banks completely, but change what banks do or what intermediaries do and how they do it. So the real challenge and the best thing that we all can do, honestly, is educate. Educate, talk about DeFi, and make it really accessible both to institutions and to just a broad group of entities and individuals.
Cool. Thanks a lot. And now, Rashid, to you, also kind of, we heard the yield that is very attractive for these institutions, the openness of the infrastructure. What do you see with your clients? What is attracting them? And where do they have maybe challenges where you see your role to help them to bridge it?
So from all the discussion that we had with different financial institutions, we saw different categories. So you have the big investment bank. There is absolutely huge interest into DeFi. However, it's not the most important thing that they will do now. They are building infrastructure, custody, and this is, for example, when we saw Metaco that are giving access to API for infrastructure for custody. So they want really to have the infrastructure in order to prepare. Then we see, for example, private banks. Private banks, they are much more flexible. So we saw everything around tokenization of illiquid assets, everything around short-term financing backed by collateral, which are really interesting. And we saw some private banks that are already providing staking, and they want to go into the liquidity mining, for example. However, liquidity mining, there are problems in terms of who is giving liquidity, KYC, AML, and all these compliance and regulatory, I would say, blockers that they will not allow them basically to do it now because they have strict, I would say, compliance and regulatory rules. And then
just quickly, maybe for the audience, liquidity mining, just kind of from somebody coming from TradFi, can you explain it in a couple of words so that they get an idea?
Of course. So liquidity mining, it's basically providing. So what is amazing about DeFi, it's when we start to have what we call automatic market making. Okay. So, and this is what we started, for example, we saw Boncor, we saw Uniswap, Balancer, and all these different kind of decentralized exchange. So, and this create amazing wave where if project want to have enough liquidity, it will have it from different liquidity providers, which are you, me, it could be anyone. And because they provide liquidity, which will impact positively the project in terms of liquidity, they will receive this reward. And this reward is coming, of course, from the token. So, and this is why we put the difference between yield farming and liquidity mining. Now, the problem with liquidity mining is the risk that is inherent to this automatic market making. So what we call impermanent loss, which is simply the difference between the portfolio that you have, so two assets that you have that you don't touch, you hold, And these two assets, if you provide them into this automatic market making or into this liquidity pool. And this difference basically is what we call impermanent loss. And this is also why we see few blockers now for a lot of, I would say, even with a lot of money to be able to be provided, they are afraid from these different risks. And this is why I believe that the field of decentralized exchange is just starting. We will see many innovations. Now, yeah, so banks, they want to provide liquidity also into DEX. But because there is, of course, the fees, they can get 0.3% in term every transaction, basically. And then they will have a lot of benefits without even speaking about the yield. The problem is, again, the blocker, KYC, AML. And even if there are solutions into KYC, AML, the problem is there is no one standard. So there is a way that this bank is doing it, or these jurisdictions. So this is where we will need basically to work into different type of standard that can be used. And if we arrive to this level, I think this is where we will see like a really big adoption for these financial institutions.
Okay, cool. Thanks a lot. So we've seen the opportunities that we have, and now starting to see also the challenges and risks. So let's in the next step focus a bit on that. So if also for the others, or maybe we start with you, Andreas, kind of people that see these amazing opportunities, kind of what they have to expect if they want to tap into that. What are the challenges you see out there besides what Rashid already kind of said?
Yeah, I think currently, I mean, you know, next to all the business operational questions, I think from a legal end and regulatory end, the key concerns of regulator are currently around AML regulations. I think that's the key focus. And then about financial market infrastructure services that you could qualify as one. This is in particular the case, of course, if you have some kind of relation or with securities. But AML is currently one of the strong focus. So the key question there is, well, how do you avoid that the funds are being contaminated, which you as an institution then interact with, or you allow your clients to interact with? And so the topic is around, for example, like Rebecca mentioned, how to whitelist tools. What does whitelisting means of those pools? What do? Do you just simply add a chain analysis assessment? Do you actually onboard users and identify them? So that there are various means how to address that. And I think we're going to see many different methods until one has been proven to be making the regulators happy.
I think we can go even further there, because I've seen already one question that was asked, and I would like to bring that topic in, the topic of the stable coins, especially also. That brings in really, again, a huge difficulty. Again, Europe sees digital currencies, stable coins different than Switzerland, than the US, than Asia. And there, for example, we have the point where the European Banking Association announced or told to every single regulator in Europe that they will not be allowed to issue a stable coin based as under e-money as long as MiCA, markets and crypto assets, will not be in place, and it will be 2024. So we again have here a way of, we use in this DeFi world stable coins, digital currencies, but in the end, how can we really issue them? Because it should be in Europe e-money, but we are not allowed to issue e-money as a stable coin. So we have there also on a business side, really big challenges. Are we even allowed to use it? Yes, KYC side, it's fine, but is the asset we are interacting compliant with European regulation or Swiss regulation?
Can you allude on that a bit further, kind of from a company perspective, yes, that maybe wants to offer DeFi products or is looking into that? Kind of where do you see the risk, or where is most of your energy going into to explore these opportunities?
It's definitely a good point. And for example, Bitcoin Swiss is at the moment not a bank, not an investment firm, and therefore everything we touch that is an asset could be a risk for us or is a risk for us. And therefore the question here is, which stablecoin is an asset, which not? What is it really doing? Is it a payment method? Is it a utility? Is it an asset? And that brings in a lot of risks that we have to look at, that we have to consider. And therefore we really take care what we offer. And Yes, for a Swiss company, it's that. For me, as a Liechtenstein company, it's something different. As a German company, even if we are both in the European Economic Area, Liechtenstein and Germany, it's again something different. As long as we do not have a global regulation or even get smaller, a European regulation, there are many risks you need to look at as a company, because what you could do in country A is 100% legal, and in country B, it could be a risk. And there again, I'm really a big fan of regulation, and we should have European-wide regulation. We should have even some global standards, again, that I, as a Swiss bank in the future, or Liechtensteinian bank or whatsoever, or German bank, can work with a US bank in a DeFi protocol without being scared that I touch US companies.
I mean, this sounds a lot of kind of also traditional finance. So the question that comes up kind of, if you now apply all this regulation, kind of you need to look into all these topics, what's left at the end for institutions for DeFi? And I mean, Rashid, looking at you, you also work kind of in traditional banking, you know, DeFi. So kind of what can we save of the retail DeFi that's so open and everybody can block in for institutions?
So first of all, DeFi is here because of retail. So, and also because of this, we will have access, open access to everything without being subject to regulation. So regulation also, like, it's here in order to protect the consumer. And if we see, like, in terms of hacks for the bridges, just lately what happened, like millions of dollars that was hacked, like we see all the different protocols, and of course this is related also to the quality of the code. And this is, I think, one of the reasons, I would say, challenge for financial institutions to use any protocol, because there are norms. For example, if you want to use software provider, you need to be compliant with for ISO 27001. So to come back to the retail, so for us, if you have strict regulation in order to KYC every single user with centralized KYC entity, it might have a huge impact into all this liquidity that is basically brought by the retailers. So we think, and what we are trying to develop is what we call the trustless identity verification. And actually, this exists already in Sweden and in Denmark. You have centralized way where you have all the different KYC for most of the population, basically, and anyone need to see if someone is verified, they just tap that. Of course, we don't want to do something centralized, but this is why we call it trustless identity. So instead of obliging the users and the retail to do the KYC with the entity that will hold their data and they don't know what will happen, so the user do his own KYC, which will be its own passport, and then he can give or revoke access, basically. Of course, there is a lot of work in order to be accepted. What are the standards? Who is doing the KYC? And there are also potential solutions, proof of authority, where you have different KYC providers that are validated by the regulator, for example, that are in different jurisdictions. So if we want to have the advantage of DeFi, to make sure that the retail are benefiting without, I would say, giving access to all their data, and also having financial institutions flowing and having, I would say, taking advantage from DCL and all the opportunities, we need to have this kind of tools, trustless identity verification, where the users have in control. And here we will be in between. We are not in the two extremes. So this is, for me, where I would love and where we want to be able to develop.
Raji, do you think that would even be compliant with the FATF travel rule that is also getting stronger and stronger every now and then? And so how do you see that?
I think this is a really good point. So actually we discussed this with our Chief Compliance Officer, and we are able to include this, what we call a compliance rule engine, okay? So you spoke about MiCA. So MiCA, it will come into force, so it will regulate the digital asset, and every project that is working with users that have access to their services, they need to have access to all the data, basically, okay? Then if you give the opportunity, so if you have your rule engine, I accept, for example, let's say investors from UK, but I cannot accept investors if they are below certain, I would say, thing in the US, and then you have all the rules that you can include. So basically, it will be embedded with this trustless. So the user have his data, it will go to this rule, and this rule, basically all the rules are the one that the project need to comply, or the bank. So you can always have this compliance. And as you know, like compliance is a huge burden for financial institutions. Sometimes it can go up to 10% of their revenue. And it's a lot of manual. I see huge opportunity into everything around RegTech and cross-border rules. And we need to include MiCA, FAT rules. And also I know that there are a few things that we need to be able to comply with.
And that is what I really like. I always push that also to the banks where I explain it's like, and the good thing is now with all the MiFID regulation and everything, this data is never up to date. But with your solution, you will be always, every single second up to date. If you make some trades with a special product, the identity will know it, and therefore you will be upgraded in your level. And that's amazing. And I really, really like that. It will be, it's always regulators are scared because of money laundering, but in the end, blockchain will help us to be way more compliant and have even way higher investor protection. And that's what I really like with the whole DeFi development that's happening out there.
And that's also what we see from a regulatory and policymaker perspective. So on one hand, I mean, we've discussed today a lot about, you know, integrating DeFi and institution starting adopt and try out and DeFi technologies. I think that's a very important step in one direction. But in the meantime, that also means that institutions realize that their concepts of what are the risks related to the business and where they could enhance efficiencies, like Rashid mentioned, they're substantial. So I think in parallel to the adoption side on the institution, now we start having a lot of conversations on a policymaker front to explain, as Rebecca said earlier, what is DeFi about, what is it work, how does it work, and especially what are the risks and where do we have other risks than we have in the traditional finance system, which should lead at the end of the day in new regulations or lighter regulations addressing those risks which may be new, but eliminating those out of the regulations which are no longer existent due to the technology.
So we have only a couple of minutes left. So let's use the last minutes we have to have an outlook, look 2 or 3 years ahead, kind of how will the landscape look like? And let's try to do that really from a customer perspective. I mean, you're in these projects, just looking in the kind of in the future, what do you think kind of, or what will you be excited that end user customers of institution will able to do in by accessing DeFi through institutions? Are there any use cases you think that's something we'll see in 3 years that you think is exciting and people will be using? For example, I mean, Andres, you mentioned investment management or kind of accessing the yield. So will this be?
Absolutely. I do believe the question is a bit tricky. In a way, it could be understood as like, what is going to be different for the customer than today? And if you look at the crypto savvy DeFi user, you know, he's still going to have his ecosystem he can use, hopefully. And so he doesn't need to rely on the banks helping him getting to the products of DeFi. On the other hand, if you look at a user which is not in this community and comes from a different world, he needs someone, you know, opening this door and taking the risks and doing all the technical stuff. And there, I think there's a lot of potential for a lot of people to just have a new way of financial investments. And on the other hand, to hopefully also have more classical types of investment, like an asset management in a more secure way, by not having to trust an asset manager using or a custodian holding his assets, but trusting the technology, allowing that, and just kind of have a hard-coded frame of investment possibilities the asset manager has, like in Enzyme Vault, for example.
That's also what I really like, the investment possibilities, because I'm quite sure 3 years could be early, but I would say 3 to 10 years, everything will be digitized or tokenized. And therefore, everyone will have access to way more investment possibilities. And on the other side, we will have some kind, as mentioned by Rashid, a digital identity that is always up to date. So everyone in this world that has nowadays no access to financial services will have access to it. And everyone that already has it will have a better access to it. But what's very important for me is the user friendliness. If I nowadays explain to someone how they have to get access to DeFi, they are scared and it's so complicated. I need to make too many steps, need to write down too many things, seed phrases and so on. And I look very forward to that area improving and making it easier for investors on a side to get access and also to protect them for losing their assets.
I would add that like I completely agree with you in terms of user experience actually. So like even Uniswap, which is super easy, for example, in the beginning, even people that were in crypto, it was not straightforward, basically the way that you need to put the address and start trading. And I think that is for me, like if we see in the 3 years, so in the traditional finance, we have, of course, quantitative finance, we have quantitative portfolio management. So for me, I am sure that we will go into quantitative pool management, quantitative yield management, having middleware tools to be able to build strategies. And we will not see, because now if you want to go from Polkadot to Ethereum to Avalanche to Polygon, you need to use bridge, you don't know if they are secure, and so on and so forth. We will have this layer on top that is not only give you access to all the best features in different chain or different protocol, but also in terms of liquidity. One of the biggest problems is liquidity. And if we manage to optimize the liquidity and have the right, in order to get the least impact when you are doing trade or whatever you're doing, I think this is where we will see like amazing usage and adoption. The other one is I can see huge innovation into decentralized exchange space, and I see connection between centralized exchange and decentralized exchange, where we have a layer on top. Of course, always like you said, the easy access. So I don't need to connect different wallets and different things to be able to have access. But if you have this layer, you will be able to tap into centralized exchange, decentralized exchange. And just, I want to give one example. So I don't know if, sorry?
Yeah, so I think we need to wrap it up from a time perspective.
I had one great example, but anyway.
Yeah, so if it's really short, but then we need to wrap up.
Yeah, DeFi, it will be the exactly same thing as what happened in the digital transformation in the retail banking. We all know the case of DBS in Singapore, how there was really one of the, I would say, worst banks. They become one of the best banks in order of also putting the users really at the center, and it has absolute huge growth. I don't see DeFi and traditional finance as separated. I see them basically as connected to create this digital transformation for the whole investment industry. And it will create amazing opportunities. And it's just the beginning.
Cool. What a great ending. We need to wrap it up. Thanks a lot for participating in this panel. And yes, I wish you all a great rest of the day.
It was a pleasure. Thank you very much. Bye.
Thanks. Bye, Mauro. Bye, Roger. Bye, Mike.